Hey there, EK fam, it's Aaron here. I just wanted to give you a quick message about the current, a bit of commentary on the market that's happening at the moment. There's a bit of activity that's been happening in the last week. The market fell about 4%, but today we've had an increase of about 0.5%. So some solid gains there, but yeah, we are down about 3.5% over the last 5 days or so. Had a few people inquiring about it. What do we do? Do we change, go more conservative, and so forth, right? Now, I just want to let you know that all our clients that we sit with, once or twice a year, we have tailored made your portfolios in your super and your pension funds and everything specifically based on your needs, your circumstances, and what you need. If you are anywhere from 4, 5, 6 years or longer away from retirement, typically would be invested in the market. We've got our strategy set up with our Weinberg portfolios, with Elston managing those. They're keeping an eye on the stock portfolios and they're actively managing, meaning they're making changes if need be. If you're within either retired or you're within the next kind of 2 years of retirement, we're probably most likely in your super or pension funds have got some sort of bucket strategy approach where we've got allocated money, worked out how much you need to live off each year, then we've allocated some of that, like a year income, into cash, some term deposits, and some low volatile other assets, so some income funds and so forth. So there's some certainty there, or some assurance if the market drops. Hey, we've got a couple of years of income sitting there in cash. We can live off and pay you in retirement, and then your assets that are falling in value are the growth assets, or shares. But if the market drops, I'm saying. But the idea is we don't need to touch them for quite some time and a couple of years to let them grow, right? So I just want to talk about a bit more about like time in the market and bull and bear markets, right? So just a bit more of an education, bit of information for you guys. First thing, this slide is pretty important, right? So it just talks about three different investor types, right? Number one is the person that stayed invested. So they whatever happened to the market, they just said, yep, I understand it's volatility. We need volatility to get growth, and I'm happy just to ride it through and keep invested. Second type of client would be someone that maybe moved to cash for 1 year, because they just couldn't handle anymore. Then they got back into the market. Typically, it does take a while if you go to cash to get back in, because you want to see the market recover, then you get back in. So you miss out on that initial upswing here, which is a massive gain. And then the third type of client maybe moved to cash and never got back in and just stayed there altogether. So all my clients are the stay invested clients. Obviously, you guys, you trust in us. We've got a great portfolio structure set up for you guys, and we've built them specifically tailored for your needs. But let's look at the difference in what it looks like if you try to get out of the market and get back in, or whatever it might be, right? So here's GFC, August 07. This is when I started. I started March 07 advising, so I had a pretty early start into the career, as in pretty big learning curve pretty quickly, right? GFC hit 16-month period, we had a negative of 50%. So it was a lot of conversations for me talking to clients in that period of time. The client that stays invested, or the person that stays invested, right? Look, yes, it's not nice seeing this happening, but if you're still working, your contributions going in as well. You're buying shares as the market's falling, so you're buying cheaper, and you're buying the upsell as well, right? But what we typically see, this increase here, so as soon as you hit the bottom, that initial bull run to start off is a lot. Like that will be a 20-30% gain in a very short period. And then we saw here that we had a bull run that lasted for probably 150 months. And then we had COVID hit here, and then another bull run after that. That was only a 2-month drawdown there and a big increase. But the person that stays invested, right, their portfolio from back here is sitting at about $578,000. The person that gets out into cash for 12 months and gets back in, typically, as I said, look, if they get out here at the bottom, they're selling out at the low and then buying back in here at the high, which is just the worst strategy. But doing that, they start increasing with the market, but they are $130,000 behind the person that stayed invested, because that initial takeoff here, that's a massive increase. Just missing out on 2 or 3 best days in the market is tens of thousands of dollars impact, which is not good. And then the person that goes to cash completely and sits there, obviously cash hardly keeps up with inflation. You got about 230 grand. So massive differences there, about $340,000 difference between the person that stayed invested. So it's important just to show you guys, illustrate the importance of staying invested, stay in the path. There's a reason we've got you in your certain portfolios, so stick to it. Bull and bear markets. So let's look at these. So this is from March 24, updated all the markets, right? So this is for the last kind of since 1942. This is the S&P 500. So this is the US market, the top 500 companies in America. And a bear market is obviously these blue downturns. So they are when the market runs a negative. So people say recession, market crash, whatever it might be, but this is what's called a bear market. So the market goes into hibernation like a bear and it just obviously drops. So over here is GFC as I showed on the last slide. So 16 months of a negative 52% return. I've been advising through that. We had obviously 3-month bear market here of COVID when we lost 20 odd percent. And then there's been another run. No, sorry, here, COVID's here. Sorry, apologies here. So either way, this is what the US markets have done. But as you can see, every bear market's followed by a massive bear market, right? And the bear market are these green squiggles here, the volatility. So you can see here, GFC, as I said, 50% loss, 16 months. But after that, we increased by 339% over 130 months. And the bull markets do last a lot longer than the bear market does. So as long as you can stay the course, ride out the bear market, you'll benefit from the bull market. You just can't pick where the top of these markets or bottoms are. So it's too hard to get in, get out. You're not tactically trying to change and do that. You miss out on 2 or 3 good days in the market. You miss out on lots and lots and lots of money. So trying to move out and back into the market is a silly idea, but riding through it is key, right? So you can see here the average bull length is about 53 months. So you think about that, you're talking nearly 2 years. Sorry, it's more than 2 years. So yeah, what am I talking about? So 2 to 3 years almost is a bull market length. And a bear market length is about 15-month average, so about a 12-month period. And you can see there the average bear market's about 31% drawdown negative and about 155% positive in the bull runs. Final slide here is the Australian ordinaries one. So the all ordinaries, so the Australian share market, a bit more familiar to you guys. So this is from 1973, not as far back as the S&P 500. But as you can see here, there's the there is GFC, so negative 50% over 16 months, followed by 110% almost over 131 months. So you can see here very similar numbers. A bull market is even longer in Australia. It's about 68 months, right? So I can't do my maths in my head, but we're talking 5.6 years is the average bull market. So 5 years of positive growth with maybe 12 months, a bit more, 14 months of a negative, followed by a negative market, right? But your negative's about a 37% drop, where your bulls are an average of 159% increase. So the idea of this is just to educate guys, look, even if I'm not saying this is going to happen, I'm not saying market's going to fall tomorrow, but if there is a downturn coming in 6 months, 12 months, 18 months, whatever it might be, we've structured your portfolios. If you're retired, we've got money sitting in cash on the sidelines to pay you. If you've got quite a long horizon to invest, we're going to stick to the strategy because you want to ride through these, because if you miss out, and as we showed before, if you miss out and try and get back in, it can cost you hundreds of thousands of dollars. So any questions, let me know, guys. I just wanted to shoot this message out to you guys, give you a bit of an understanding of if there's a bit more chatter coming out in the media and the news, or your friends, family, whatever it might be. Just remember, we're looking after you, we're looking after your money and your strategy, and we're confident in what we're doing. But just if there's a bit of an uncertain time coming, we've just got to ride through it, stick together, and we'll see the benefits on the other side. Thanks, guys. Any questions, let me know. See ya. Bye.